The European Central Bank is jumping ahead of the Federal Reserve by announcing that they will cut key interest rates by a quarter point.
That's right. Now, this move is unusual because while both are independent, in the past, the ECB usually takes its cues from the Federal Reserve here in the U.S. The Fed, for its part, has not announced any interest rate cuts yet. Inflation across the country is currently at 3.4%, while inflation in Europe is now at 2.6%. The latest numbers are giving the ECB confidence it will hit its target of 2% by next year. Today's move marks the first time the European Central Bank has cut interest rates since 2019.
CBS News foreign correspondent Ramy Inocencio joins us now from London. So, Ramy, the U.S. economy has actually been, by many metrics, more robust than the U.K. and those in Europe. Why are we seeing the European Central Bank make these cuts now?
Right, absolutely, Lana. The U.S. economy is chugging along, and it seems like all these interest rates that have been piling on still can't stop it. But here, at least in the Eurozone, it really is in the numbers. We've got a graph of Eurozone inflation. Why don't we go and pull that up right now, and I'll walk you through this. Back in late 2022, the inflation for the Eurozone hit a record of more than 10%. You'll see that peak at the top of your screen, 10.6%. And you'll remember in the few years prior to that, we were coming out of COVID, buying things after pent-up demand, supply chain disruptions, right? And then Russia invaded Ukraine. But then you can see that green line start to fall to where we are now. The ECB had no choice but to hike rates, in effect tapping the brakes to slow down demand, which in turn, of course, helps slow inflation because, right, if things are more expensive, you're probably going to buy less. Now, fast forward 18 months later, and Eurozone inflation is now closing in on that 2% mark. And that is important, guys, because the ECB's traditional target is 2%. So they're feeling confident, if not maybe even a bit happy, that it's finally winning its war on rising costs over nearly the past 2 years.
So, Ramy, that helps explain why European central banks that usually follow the Fed's lead on interest rates have, in a way, leapfrogged it this time. Talk to me more about any potential connection between the two. I mean, there's so much business between the U.S. and European nations and the U.K. Any kind of understanding of what that means for the U.S. or for Europe?
Right. You know, basically, since the United States, we know, is the biggest economy in the world, all other countries, whether they like it or not, take cues and then adjust their own monetary policies because the dollar, as we all say, is king. But this time it's different. And the term that's now rising again is rate divergence. The president of the ECB, Christine Lagarde, has stressed that the ECB does, what it does is data dependent on the numbers and not Fed dependent, meaning what's happening in the US, and that the ECB is really going to care about inflation in its own backyard before anyone else's. And a reminder, 3.4%, you just saw on your screen, annual US inflation. In the Eurozone, 2.6%. One concern, though, speaking to your question, Errol, is that higher interest rates in the U.S. would mean that there's a stronger dollar where you are, which would theoretically pull even more investment into the United States, and that would be a negative for the euro. But history has actually shown, whether you like it or not, maybe thankfully for many people, that the difference there hasn't been all that much.
All right, some encouraging news from Europe. Ramy Inocencio, across all of it, thank you so much.
You bet.